When assessing investments, the typical notion is to gain from the rise in asset prices and incur losses as they decline. However, a more sophisticated approach is short selling or shorting, which revolves around speculating against an asset by anticipating its future price decrease. Shorting is often linked with the stock market, but the practice extends to cryptocurrencies. Many digital assets exhibit high volatility, leading to substantial profits or losses within brief time frames. The prospect of huge profits allures many investors to short cryptocurrencies. This article examines cryptocurrency shorting, unraveling its nature and mechanics comprehensively. You can also visit Cryptocurrency Help to learn more about crypto investment. Shorting cryptocurrency involves selling crypto at a higher price to repurchase it at a lower price later, usually when there's an expectation of the cryptocurrency's value decreasing. The term short selling comes from being short on the cryptocurrency, meaning you don't actually own it. To understand this concept, you need to know what long and short positions are in cryptocurrency. Going long means buying cryptocurrency with the belief that its value will increase